Every single financial story that dominated 2026 is connected. The war in Iran, the gold price at $5,400, the $38.6 trillion national debt, the 30,000 tech layoffs, the student loan crisis, the frozen housing market, Bitcoin crashing 40%, the Supreme Court destroying Trump's tariffs, and a Federal Reserve about to get a new boss who wants to rewrite the rules of American monetary policy. These are not separate stories happening in parallel. They are chapters in a single book being written about the most consequential financial year most living Americans will ever experience. And the devastating truth is that most people watching their portfolios, paying their mortgages, worrying about their jobs, and filling up their gas tanks have no idea how deeply these stories are connected or what the connection means for their financial future. Today, we are going to change that. This is the complete 2026 financial survival guide, and by the time this video is over, you will understand not just what is happening, but why it is happening, how it all fits together, and exactly what you need to do about it. Before we go any further, take 5 seconds right now and hit the like button. This is the most comprehensive financial video we have ever produced, and getting it in front of the people who need it depends entirely on your support. Share this video with everyone in your life who has money in the market, a mortgage, student loans, or a job in a field being disrupted by artificial intelligence, because everything we are about to cover applies directly to them. Subscribe to this channel and press the bell notification so you never miss a future update. We publish financial analysis that connects the dots in exactly this way every single week, and being informed in 2026 is not optional, it is survival. Now let us start building the complete picture. Chapter 1. The War Economy and How the Iran Crisis is Making Every Other Financial Problem Harder to Solve. On February 28, 2026, the United States and Israel launched Operation Epic Fury, a coordinated military campaign targeting Iran's nuclear infrastructure, ballistic missile facilities, and military command centers. Within 48 hours, Iranian Supreme Leader Ayatollah Ali Khamenei was confirmed dead. The Strait of Hormuz was effectively closed to commercial shipping. Over 115 oil tankers were stranded, unable to transit the world's most critical energy corridor, and Brent crude oil had surged 13% to $82 per barrel in a single session. 3 American service members were dead. Dubai had been struck by Iranian missiles. The global economy had absorbed a shock that no financial model fully anticipated. Here is why the Iran war is not just a geopolitical story. It is a financial accelerant that is pouring fuel on every other economic fire that was already burning in 2026. To understand this, you need to understand one number, 20. Approximately 20% of the world's daily oil supply transits the Strait of Hormuz, 20 million barrels per day, $500 billion of annual energy trade. When that corridor closes, the ripple effects do not stay in the Persian Gulf. They travel instantaneously to every gas station, every airline ticket price, every factory electricity bill, and every central bank interest rate decision on Earth. The most direct connection is inflation. The United States was already fighting a stubborn inflation problem before the Iran war began. The December 2025 Personal Consumption Expenditures Index, the Federal Reserve's preferred inflation gauge, came in at 0.4% month over month, well above the 0.2% reading from the prior month, and above the consensus forecast. The Federal Reserve was already in a difficult position, unable to cut rates aggressively because inflation would not cooperate. Now add a 13% oil spike to that environment. Every $10 increase in the price of Brent crude adds approximately 25 cents per gallon to U.S. retail gasoline prices, a move from $73 to $100 per barrel, which Goldman Sachs explicitly warned was possible if the Hormuz closure lasted beyond 2 weeks, would add 65 to 70 cents per gallon to the cost of gasoline for every American driver. For a household filling a 15-gallon tank twice a week, that is an additional $1,040 per year in gasoline costs alone, landing on top of a consumer who is already maxed out on credit cards at 24% interest rates and behind on student loan payments. The Federal Reserve connection runs even deeper. The Fed under Jerome Powell was already navigating the most difficult monetary policy environment since the 1970s, trying to balance stubborn inflation against slowing GDP growth that came in at just 1.4% annualized in the fourth quarter of 2025. Kevin Warsh, nominated to replace Powell as Fed chairman, has signaled he supports rate cuts driven by AI productivity gains, but an oil shock that pushes inflation higher makes those cuts nearly impossible to justify. The war in Iran has effectively trapped the Federal Reserve in a corner where cutting rates risks igniting inflation and holding rates risks strangling a slowing economy. That trap has a name. It is called stagflation, and it is the most destructive macroeconomic environment for ordinary household finances that exists in the modern economic playbook. The war economy also connects directly to the national debt crisis. Military operations at the scale of Operation Epic Fury cost tens of billions of dollars. The United States was already projected to run a $1.9 trillion federal deficit in fiscal 2026 before a single bomb was dropped on Iran. Military procurement, ammunition replenishment, carrier strike group deployments, and the inevitable reconstruction and humanitarian commitments that follow major military operations all add to a national debt that was already at $38.6 trillion and growing at $50 billion per day. War does not reduce deficits, it expands them, and every additional dollar of deficit spending adds to the compounding interest bill that already exceeds the entire U.S. defense budget at $1.2 trillion per year. Chapter 2. The Debt Trap and the Economy Running on Borrowed Time. Step back from the immediate drama of the Iran war and look at the broader financial architecture of the American economy in 2026, and a single organizing principle emerges. This is an economy that has been running on borrowed money at every level simultaneously, and 2026 is the year when the bill is beginning to come due at the government level, the corporate level, and the household level all at once. At the government level, the numbers are staggering in their scale. The U.S. national debt stands at $38.6 trillion. The Congressional Budget Office projects a federal deficit of $1.9 trillion in fiscal 2026. Annual interest payments on the national debt reached $1.2 trillion in fiscal 2025, surpassing both the entire defense budget and the entire Medicare budget for the first time in American history. The CBO projects that federal debt held by the public will rise from 101% of GDP today to 120% of GDP by 2036, surpassing the previous all-time record set in the aftermath of World War II. And approximately $9 trillion of maturing Treasury securities must be refinanced in 2026 alone, meaning all that old low-interest debt gets replaced with new high-interest debt at today's rates, mechanically increasing the annual interest bill year after year regardless of what Congress does. These numbers are not just abstract statistics. They have direct consequences for interest rates throughout the economy. When the Treasury floods the bond market with supply to finance these deficits and refinancings, bond prices fall and yields rise. When Treasury yields rise, mortgage rates rise, corporate borrowing costs rise, and consumer loan rates rise. The fiscal irresponsibility of the federal government eventually shows up in your mortgage payment. The transmission mechanism is slow, but it is mathematically unavoidable. At the household level, the picture is equally alarming. Total American credit card balances hit $1.28 trillion at the end of 2025, the highest level ever recorded since the Federal Reserve Bank of New York began tracking this data in 1999. That represents a 38% increase from the pre-pandemic level of $927 billion in 2019. The average annual percentage rate on new credit card accounts is 23.77%. 60% of American credit card holders carry a balance from month to month, meaning they are paying nearly 24% annual interest on money they borrowed to buy groceries, pay utilities, and cover the ordinary expenses of daily life. The student loan crisis adds another dimension to this debt trap that threatens to freeze the economic mobility of an entire generation. Nearly 1 in 4 American student loan borrowers with a payment currently due is delinquent. Approximately 9 million borrowers are now in default, the largest number ever recorded in United States history. Credit scores for 8 million delinquent borrowers have dropped by an average of 57 points, plunging 3/4 of them into deep subprime territory. 2 million borrowers who were near prime just 1 year ago have seen their scores crash by 100 points to an average of 580, making mortgage qualification essentially impossible. And 37% of Gen Z borrowers and 36% of millennial borrowers have explicitly delayed buying a home because of their student debt burden. These three debt crises, government, consumer, and student, are not independent. They interact and amplify each other. High government debt pushes up interest rates, which pushes up the cost of consumer debt, which consumes more of household income, which reduces consumer spending, which slows economic growth, which reduces tax revenues, which widens the government deficit. This is the debt spiral that economists fear, and that the data in 2026 suggests is already in its early stages. Chapter 3. The AI Contradiction and the Most Expensive Experiment in Business History. While the debt crisis was building and the war in Iran was escalating, the most celebrated story in financial markets was the artificial intelligence revolution, and it genuinely is a revolution. The combined capital expenditure commitments of the 7 largest American technology companies toward AI infrastructure in 2026 total approximately $700 billion. Gartner projects worldwide AI spending will reach $2.5 trillion globally in 2026. NVIDIA reported quarterly revenue of $57 billion in its third fiscal quarter, with data center revenue growing 66% year over year. Jensen Huang described demand for Blackwell chips as off the charts. The AI narrative drove the S&P 500 to record highs and made Palantir the best-performing stock in the index in 2025 with a 155% gain. But here's the contradiction that is hiding in plain sight inside the most celebrated financial story of our era. The companies spending hundreds of billions on AI are simultaneously eliminating hundreds of thousands of the white-collar jobs that define the American middle class. And the data is now beginning to show that the productivity gains that were supposed to justify all of that spending and all of those layoffs are not yet appearing in the broader economic numbers. The job cuts are real and they are accelerating. Over 30,700 confirmed tech sector job losses were recorded in just the first 6 weeks of 2026. Amazon confirmed 16,000 corporate layoffs driven explicitly by AI automation, following 14,000 cuts in October 2025, bringing total Amazon white-collar reductions to 30,000 people in 4 months. UPS announced 30,000 additional operational position eliminations in 2026, following 48,000 cuts in 2025, for a combined 2-year reduction of 78,000 workers. Meta eliminated 2,500 Reality Labs positions. Pinterest cut 15% of its entire workforce, describing it as an AI pivot. Block eliminated 1,100 jobs. If the pace of 2026 layoffs continues, the total for the year could exceed 270,000 tech sector job losses, surpassing the brutal year of 2025. Now here is the productivity paradox that Wall Street is not fully reckoning with. A landmark study from the National Bureau of Economic Research involving 6,000 senior executives across the United States, United Kingdom, Germany, and Australia found that the vast majority reported seeing little to no productivity impact from AI on their company's operations. Oxford Economics applied a direct economic test to the AI productivity thesis, asking whether output per remaining worker was rising sharply as AI displaced humans, and found that productivity growth has actually decelerated. Research from the Model Evaluation and Threat Research nonprofit found that AI tools made software developers' tasks take 20% longer rather than shorter. A Tom's Hardware survey found that over 80% of companies reported no productivity gains from AI despite billions in investment. Apollo Global Management's chief economist, Torsten Slok, concluded that while profit margins in the big technology companies increased significantly, the broader Bloomberg 500 showed almost no change in profitability, suggesting that AI's financial benefits are currently concentrated in a tiny handful of companies at the very top of the technology food chain. The human consequences of this contradiction are profound. Companies are eliminating jobs in anticipation of AI productivity gains that have not yet materialized in the broad economy. Workers are being displaced in the present based on efficiency promises that belong to the future. The careers most at risk, technical writers, HR professionals, compliance officers, entry-level financial analysts, and data processing roles are precisely the white-collar jobs that millions of Americans took on significant student debt to qualify for. The AI contradiction is therefore not just a financial story. It is a social story about an entire generation being squeezed from 2 directions simultaneously, by the debt they took on to enter the professional workforce and by the technology that is now eliminating the professional workforce they entered. Chapter 4. The Dollar in Decline and the Slow-Motion Earthquake Under Global Finance. The fourth thread connecting all of these stories is the one with the longest time horizon, but arguably the most profound long-term consequences. The US dollar is losing its grip on the global financial system, and the pace of that process is accelerating in 2026 in ways that are now visible in hard data rather than just in geopolitical narratives. The IMF data is unambiguous. The dollar's share of global foreign exchange reserves has declined from 65.3% in 2016 to approximately 58.2% by January 2026. Global central banks collectively sold $48 billion of dollar reserves in January 2026 alone, bringing the dollar's reserve share to its lowest level since 1995. Those same central banks simultaneously purchased 150 tons of gold, pushing gold's share of global reserves to 12.5%. The US dollar index fell more than 9.4% in 2025 and has continued to weaken in early 2026, with JP Morgan projecting a further 3% decline through mid-year. BRICS nations announced in January 2026 they would increase the share of internal trade settled in local currencies from 35% to 50%. Russia and China now settle 90% of bilateral trade in rubles and yuan. China's cross-border interbank payment system has 1,467 indirect participants across 119 countries, and its daily transaction volume is growing at over 65% annually. ASEAN nations are building a unified regional payment system targeting 2027 completion that will reduce dollar dependency in intra-regional trade. Now layer the Iran war on top of this de-dollarization trend, and the picture becomes even more complex. Saudi Arabia, the UAE, and the Gulf Arab states are simultaneously allied with the United States militarily and engaged in quiet but accelerating shifts away from dollar dependency in their trade and reserve management. The petrodollar system, under which Gulf oil is priced and settled exclusively in US dollars, creating permanent global demand for dollar reserves, has been eroding for years, and the geopolitical disruptions of 2026 are accelerating that erosion. If Saudi Arabia or the UAE began accepting yuan, euros, or other currencies for oil sales at scale, the structural demand for US dollars and global reserves would fall sharply, potentially triggering the kind of disorderly dollar decline that JP Morgan flagged as a tail risk in its January forecast. Gold at $5,400 per ounce is the market's clearest single signal about all of this simultaneously. Gold does not pay a dividend. It does not generate earnings. It has no cash flow. The only reason rational investors pay $5,400 per ounce for it is because they believe it will hold value better than the alternatives. And right now, the market is paying $5,400 per ounce, up from approximately $4,300 at the start of 2026, which means the market has delivered a $100 per ounce gain in under 60 days. That is not a speculative bubble. That is a message. The message is that a meaningful number of the world's most sophisticated investors and central banks do not fully trust fiat currencies, government debt, or the existing financial architecture to protect value through the turbulence of 2026 and beyond. Chapter 5. The 2026 Financial Survival Guide. What you actually do now. Everything we have covered in the previous 4 chapters points to a single coherent set of actions that individuals, investors, and families can take right now to protect their financial position and position themselves for the opportunities that this environment is also creating. Let us be precise and specific. The first and most urgent priority for anyone carrying high-interest consumer debt is to eliminate it as aggressively as possible. Paying off a credit card charging 23.77% annual interest is the equivalent of earning a guaranteed 23.77% return on your money. There is no investment available to ordinary people that offers a guaranteed return even close to that number. In an environment where the stock market faces a 70% historical probability of correction in midterm election years, where oil prices are surging, where the Federal Reserve is in a policy trap, and where the broader economy is absorbing multiple simultaneous shocks, the certainty of eliminating a 24% debt obligation is more valuable than almost any speculative opportunity available in public markets. Attack your highest interest debt first, then cascade that payment toward the next debt, and use every dollar of freed cash flow to build the emergency fund that the data shows most American households critically lack. The second priority is understanding your career's exposure to artificial intelligence disruption and taking concrete steps to build genuine AI proficiency regardless of your field. The data is clear that professionals with verifiable AI skills command salaries up to 56% higher than peers without those skills. The transition from someone who does a job to someone who manages and directs AI systems that do parts of that job is the single most important career move available in 2026. The companies cutting headcount most aggressively are simultaneously unable to hire people with deep AI operational expertise. That gap is an opportunity for anyone willing to invest the time in building real competency rather than surface-level familiarity. The third priority is reviewing your investment portfolio through the specific lens of the risks we have identified in this video. The AI infrastructure build-out is real and has years to run, but at current valuations in the highest multiple AI names, execution must be flawless. The energy sector, both traditional oil and gas, and the nuclear and natural gas companies benefiting from AI data center power demand, offers genuine fundamental support at reasonable valuations. Gold and precious metals have structural tailwinds from central bank buying, dollar weakness, inflation fears, and geopolitical uncertainty that were present before the Iran war and are amplified by it. Companies serving higher-income consumers are navigating 2026 better than those dependent on middle and lower-income spending, and understanding where any consumer-facing company sits in the K-shaped economy is more important than almost any other single analytical factor. The fourth priority is building a cash reserve that gives you the ability to act when opportunity appears. The historical pattern of midterm election years shows an average intra-year drawdown of 18% in the S&P 500. Followed by an average 6-month recovery of 14% after the election. The investors who capture that recovery are those who held through the volatility rather than panic selling, and those who had some dry powder to deploy at lower prices. Building a cash reserve of 10 to 15% of your investable assets right now gives you that optionality without requiring you to predict the exact timing of a correction that may or may not materialize on any specific schedule. The fifth and most fundamental priority is staying informed with the same discipline and consistency that you apply to any other important area of your life. The gap between what is reported as financial headlines and what is actually happening in the data has rarely been as wide as it is in early 2026. The student loan crisis affecting 25% of borrowers is not front-page news. The de-dollarization trend is not being discussed at dinner tables. The AI productivity paradox, where companies are cutting jobs based on efficiency promises that the data does not yet support, is not being examined with the scrutiny it deserves. The national debt compounding silently at $50 billion per day, while Washington argues about comparatively trivial spending decisions, is not generating the alarm that its trajectory warrants. Being the person in your family, your workplace, and your social network who actually understands these connections is not just intellectually satisfying. It is financially protective in ways that compound over time exactly the way interest does. Closing. The one thing to remember from everything we covered today: if you take only one idea from this entire video, let it be this. Every major financial story of 2026, the Iran war, the gold surge, the national debt, the AI layoffs, the student loan crisis, the housing freeze, the dollar decline, and the Federal Reserve transition, is connected by a single underlying theme. The financial architecture that powered American prosperity for the last 40 years, cheap debt, dollar dominance, stable energy prices, and a growing professional middle class, is under simultaneous pressure from multiple directions at once. None of the individual pressures is necessarily fatal on its own. The dollar will not be replaced this year. The national debt will not trigger a sudden crisis this month. AI will not eliminate all white-collar jobs by year-end. The Iran war will eventually de-escalate. But the combination of all of these pressures arriving simultaneously in a midterm election year with a new Federal Reserve chairman, a fractured global trading system, and a consumer base stretched thin by years of inflation and high interest rates creates a financial environment that rewards preparation, punishes complacency, and offers genuine opportunity to those who understand what is actually happening. You now understand what is actually happening. Use that knowledge. Protect your finances. Position your portfolio. Invest in your career. And stay connected to the information that will allow you to adjust as this story continues to develop throughout the year. This has been your complete 2026 financial survival guide. If this video gave you clarity, value, and a framework for understanding the most complex financial year of your lifetime, please like it right now, share it with everyone who needs to see it, and subscribe with the bell notification so you never miss our next update. We will be here every week with the analysis that connects the dots that matter most for your money. Take care of your finances, stay informed, and we will see you in the next one.